This case looks at tailoring financial information using evidence from the United Kingdom. We're going to look at what the issue is with alternative performance measures, or APMs, why companies use them, what we can learn from the research, the International Accounting Standards Board response, and leave you with some final thoughts. The case highlights the tension related to the shift under international financial reporting standards from an income statement approach to a valuation approach. This means that the income statement doesn't always reflect the underlying operating performance of the reporting entity. Yet we know that investors focus on income statement metrics in their work, raising questions on the decision usefulness of such an approach. How widespread is this practice? Topics attracted regulatory attention from the UK Financial Reporting Council, and in 2021, it reviewed the use of alternative performance measures in UK listed companies. They found that the average number of APMs used by such companies in the sample was 16, rising to 20 for larger companies. This may be partially due to the complexity of the companies concerned and illustrates the widespread nature of such metrics. The most common APM was adjusted earnings before interest, tax, depreciation, and amortization, commonly referred to as EBITDA. Young's 2014 paper found that reported adjusted earnings is a global phenomenon and cited two key drivers. Firstly, an informative aspect that provides additional information for users, and secondly, an opportunistic aspect that hides or obscures the reality of corporate performance. However, this can be difficult for users to identify which category applies. He also noted that risks exist where the practices affect the integrity of the underlying financial reporting, and that regulation is difficult where it needs to extend beyond the boundaries of the annual report. It goes to the heart of the question, what is income? It says GSK provides earnings guidance to the investor community on the basis of adjusted results. This practice is in line with peer companies and expectations of the investor community, supporting easier comparison of the group's performance with its peers. GSK is not able to give guidance for total results as it cannot reliably forecast certain material elements of total results, particularly the future fair value movements on contingent consideration and put options that can and have given rise to significant adjustments driven by external factors such as currency and other movements in capital markets. This illustrates the limits of financial reporting under IFRS and the adjustments that need to be made to ensure comparability within certain peer groups. The International Accounting Standards Board has recognised the controversy in this area, and its response has been to produce a new definition called management performance measures. MPMs are used in external communications. They complement totals or subtotals of the financial statements and communicate an aspect of financial performance. The standard also defines several totals to be presented in the income statement, thereby offering a common starting point for such adjustments and reducing some of the prior inconsistencies. The effective date for implementation of IFRS 18 is the 1st of January 2027, although we will see some companies adopting it early. In summary, there's a tension between comparability and relevance driving adjustments to the financial accounts. IFRS seeks to balance both and increase transparency through the introduction of IFRS 18.
Thank you.